Hi, gang. Here's your market update for Tuesday, October the 8th. Now, you remember this from last week. This is our Dow Futures original trap line. And of course, here's our obligatory disclaimer. Let's give it a look. Futures trading isn't for everyone. There's risk involved. Make sure you do your homework. And everything you see here is for educational purposes only. Okay, so let's get back to this. The trap line has progressed to this level where it looks like it could retest it again. But right now, we have some interesting replication here. And this is going to represent the Dow as well. So at this low, we're down 144 hours, and it has reacted. Why is that important? Because we have some replication. The prior low is at 142. Okay, now we have the whole range of 915 points. We have the last leg of 579 points. And the last leg is 63% of the move. But the rest of the move in relation to the last leg is 1.58. And the first leg is 758 points. So that is not a coincidence. So we shall see. Now, if this thing fails, if this is the best it could do, it's probably going to drop a lot. But in a normal situation, this should have enough juice to get back to testing the trap line again. So we shall see. Same thing for the NASDAQ. I showed you last week that the NASDAQ filled that gap, and now it's chugging moderately higher. It's melting up. It's doing whatever it's doing. It's not going down. Last time we spoke, I told you this didn't look like a market that really wanted to decline, and it's not. But remember, part of this market was going to be dependent on what the oil chart did. Now, you remember this setup, 34th hour the turn bar, based on 66.34 and a 2.35 relationship of the legs. Well, this was your trap line, right? Beats the trap line. Now, here was the trap line down here. Now it made it all the way up here, and it reversed. So we've seen the Dow futures decline and come back, right? So you could say that there is some correlation going on with oil and the stock market, but the fact of the matter is oil originally spiked because they were freaking out over the fact that the war in Iran was about to have a serious escalation. That hasn't cooled, but it hasn't escalated to the most terrible level either. What's the most terrible level? I don't think we want to talk about that. Okay, so basically oil stalled. And why did oil stall? The low is on the 168 DG vibrational day of the year on the Gann calendar. Right now, from the high to here is 68 days. So if you want it, this is a really good example of how the Gann calendar readings embed itself in a pattern. And it does it on daily charts on just about every chart you could think of. And the only charts that I've ever checked it on are the ones that have good liquidity to them, good volume to them. The little, those charts that don't get a lot of trading action, I don't know. I don't mess with them. But you got good liquidity on charts, good volume, and the Gann calendar embeds itself perfectly. So what happens if oil continues to drop? Maybe the stock market does go up to that. The Dow does go up to that trap line. But I'll tell you this much. If oil is going to continue to drop, if it does drop from this setup, it's going to be more indicative of a recession as opposed to something the market should get really excited about and rally from, because oil will not always go higher. Sometimes oil will act as a fear indicator based upon world geopolitical events, but in terms of an indication for the economy, when oil goes down, there's a good chance that it will indicate that the economy is slowing down, and that will impact the market as well. And here's a setup that I would take on an intraday chart. It didn't work, but the teaching point here is you have a pretty decent reading that failed, and so you get this equivalently good move, but to the exact opposite side that we were expecting. And we see this again and again and again. And I will tell you that if you get for those of you who understand these readings, if you get a really good reading that fails, that's a good indication. I don't know that I would stop and reverse right there. I don't think that's a good strategy, but you should fight like heck to get a good low risk price going the other way, which probably would have been over here on a chart like this. So let's talk about a few traps that I've seen in the last couple of days on the Dow futures. Here we have a high. It starts dropping. Now, why should this retrace back up to the line where these two green bars who bought the top got trapped? Well, as we discussed last week, this big green bar is an inducement to the longs. And the reason that it's an inducement to the longs is that they need more liquidity to drop it. The trapdoor shuts how? 24 minutes after the hour. This is a 1-minute chart. 42 minutes after the hour. That's 18 minutes. And the bar in question is 517. So you have a perfect match that leads this to the downside. Now, what's so great about playing the trap bar as opposed to the top bar? There's less uncertainty involved. I think that the trapdoor shutting is a safer play than trying to pick highs or lows. And then if you do pick the high or low, you're basically getting a first or an A leg. And if you exit there and don't sit through the retracement, you're missing out on the bigger move. So one of the great advantages of playing this trap and inducement strategy is you're that much closer to the biggest move of the pattern, which in Elliott parlance is the third or C wave. And then there's this beauty. This was right there this morning. Here's a trap. Now, I can't say that I didn't participate in this leg. Okay, I almost did, but it was so quick that it came right back up. The thing is, whoever was doing this, you have to say they were testing to see if there were other people who would come in short to take it down. But since there was nobody there, you want to call this a failed break to the downside. Now, this is the market tell. This is like a poker game. The market is telling you what it wants to do. And if this is a legitimate trap, this thing ought to continue to break down and not come back. That would mean that there's no buyers up here, but since there were no sellers down here, it actually turned into a buy. Why? Because this was a 45-point drop, and this happened at 44 minutes after the hour. Now, since this is the trap over here, the fact that it came right back up, it ruined it. So what you should come to understand, when a trap door doesn't shut and fails, they will nibble at it, whittle away at it, and all the while they're doing that, they're ruining this trap here. So look what ultimately happened. My hunch, intuition, I don't know what you call it, was that this turned out to be the tell, the failed break to the downside. That's here. Look what this monstrosity created. It's a 95-point move to the upside. All because, well, we had the reading, but the failed trap door set us up for some whittling that ruined the potential trap over here. Polarity flipped over here. And then you got this spike. Okay? So we're looking for more of a melt up coming the next day or so. And think about it. Tomorrow is October 9th. And then October 10th. Now, why is that significant? We've hit the anniversary of the 2002 bottom, which was October 9th and 10th, and the 2007 top, which was also October 10th. So here we are. Does that really mean anything? Maybe. But the most memorable thing that I got out of this October 9th situation back in 2002, and I don't know if any of you were watching this when it happened, but October 9th, 2002 was the bottom of the internet bear. It was a 2-year drop. That was the day Maria Bartiromo went on CNBC first thing in the morning when she used to still report from the floor of the exchange, and she said it was finally safe to short stocks. I'm not making this up, okay? So that was like a really great contrary indicator. Maybe CNBC learned, because at the bottom in 2009, it was Mark Haynes who made his famous call when he actually did call the bottom of the market to within about an hour. We still have specials. The newest teaching is the ultimate guide to bull and bear traps and emotional inducements. It's a PDF manual, $37 through PayPal. Send funds to lucaswaveman@gmail.com or request an invoice. And basically, it explains traps and inducements at a deeper level, because inducements are basically, it's a strong emotion that causes you to do the wrong thing at the wrong time, because that's what market makers do. And you want to learn how to defend yourself. You want to learn how to take advantage of this stuff. So yeah, there's the traps, but there's a whole psychological teaching that goes along with it. And if you really want to go deeper, the training program is approximately 35 manuals, around 2,800 pages of It's basically an NFL-sized playbook on all the stuff that we've done over the last 8 or 9 years. It's a 12-month program, unlimited email support, and you get all the manuals. You could send me emails, and we meet on Skype like once every other week. And you must mention this video to get the discount. Don't mention the don't mention the video. You end up paying about $400 more. Finally, for those of you who are still interested and haven't gotten the Gantt calendar, it's a great manual. You see how with the bond, with the what was it, the oil market, how it embedded itself in the pattern. So YouTube special, mention the video, and you get the special price. Okay, that's about it for now, gang. See you in the next video.